Alice Gorlin earned her PhD in economics from the University of Michigan and was a professor of economics here through the 70s and 80s. She was also the first female faculty member in the School of Business. Alice made her mark as a scholar in the area of Soviet studies. Hopefully you remember what that is. She was also a gifted teacher and a generous faculty mentor. Because she cared passionately about international issues, the Gorlin Lecture Series, named in her honor, has accepted the mission to promote understanding of international issues and events. I would now like to introduce you to our 2025 Alice Gorlin Memorial Lecturer. He is Dr. Barry Eichengreen. He is the George C. Pardee and Helen N. Pardee Chair and Distinguished Professor of Economics and Professor of Political Science at the University of California, Berkeley. After earning his bachelor's in the University of California system, he went on to earn 4 degrees from Yale University, including his terminal degree in economics. He taught at Harvard University, assistant and associate professor, and then he moved to California, back home. Again, if you look at the brochure, you'll see other details about him. He has taught at Berkeley since 1987. He's a research associate of the National Bureau of Economic Research, Cambridge, Massachusetts, and a research fellow of the Center for Economic Policy Research in London. In 1997 to 1998, he was a senior policy advisor at the International Monetary Fund. He's a fellow of the American Academy of Arts and Sciences. He's the convener of the Bellagio Group of Academics and Economic Officials and chair of the Academic Advisory Committee of the Peterson Institute of International Economics. And we've had a lot of people from the Peterson Institute give this lecture. He also held Guggenheim and Fulbright fellowships and has been a fellow of the Center for Advanced Study in the Behavioral Sciences and the Institute of Advanced Study in Berlin. He's a regular monthly columnist for Project Syndicate. He has numerous books. I'll just mention 1 or 2. How Global Currencies Work, Past, Present, and Future. The Korean Economy, From a Miraculous Past to a Sustainable Future. Renminbi Internationalization, Achievements, Prospects, and Challenges. The Great Depression, the Great Recession, and the Uses and Misuses of History. I need to read that one. He was awarded the Economic History Association's Jonathan Hughes Prize for Excellence and the University of California's Social Science Division's Distinguished Teaching Award. Dr. Eichengreen's research interests have included exchange rates and capital flows, gold standard and Great Depression, the European economy, European integration, the Euro, and Stability and Growth and the Stability and Growth Pact, Asian integration and development with a focus on exchange rates and financial markets, and the impact of China on the international economic and financial system. I need to stop. Dr. Eichengreen will address us today on the topic, the dollar and its discontents. It's a very great honor and privilege to have him here at Oakland University. Ladies and gentlemen, please join me in giving a warm welcome to the 2025 Alice Gorlin Memorial Lecture.
So thank you for the very kind introduction, and thanks to everyone today for their hospitality as well. I'm delighted and honored to be the Gorlin lecturer for 2025. If I understand correctly, you have had at least 4 of my co-authors as previous Gorlin lecturers. Jeff Frieden from Harvard, let me see if I can remember all of them. Peter Henry, now from Stanford and Hoover. Brad DeLong, who is my colleague at Berkeley. Jeffrey Sachs, who's now at Columbia. And you've had one of my closest friends from graduate school years, Nancy Birdsall, also as a Gorlin lecturer. So I stand in good company, for sure. This topic, the dollar and its discontents, is an early view of the book that is supposed to come out early next year from Princeton University Press. So it is supposed to come out early next year if I succeed in getting the manuscript to the press next month. So we haven't finalized a title, not having finalized the manuscript. We obviously don't have a cover for the book, but I asked ChatGPT what the cover would look like, and that's what it produced. So we were talking about the poster that you produced for the Gorlin lecture, which was actually quite elegant and kind of along the lines of a similar theme. Anyway, this is the best I could do as a result of a series of 2 or 3 prompts to ChatGPT. And I kind of suspect it's going to put book cover designers out of business in the longer run. So the topic of the book, the jumping off point for the book, is the fact that the dollar is not only our currency in the United States, but it's the go-to currency for the world. Other countries use dollars in their trade. They use dollars in their trade with the United States. But they use dollars more widely in trade amongst themselves, between pairs, groups of countries, in transactions that never cross U.S. shores. A majority of global exports and imports are invoiced and settled in dollars, even though we, the United States, account for only like 15% of global trade. The dollar is similarly the dominant currency in international banking. The vast majority of international and foreign bank loans and deposits are denominated in dollars. The dollar is bought and sold in more than 80% of all foreign exchange transactions around the world, and more than half of the foreign currency reserves held by central banks and governments around the world are held in bank deposits in the United States or US Treasury bills and bonds. For good reason. The United States is the single largest economy in the world. It's been the single largest economy in the world for well more now than a century. It is a leading exporter, so we have been overtaken as an exporter by China, but not by much and not for long. The market in US Treasury bonds is the single largest and most liquid, meaning easy to get in and out of at low cost, financial market in the world, and our Treasury market is freely open to foreign investors. And the popularity of the dollar, the widespread use of the dollar, feeds on itself. This is what economists refer to as network effects, that other people in your financial and commercial network around the world use, hold, accept dollars when making and taking payment, makes it logical for you, other people, to do the same. That so many importers, exporters, and investors use dollars when conducting cross-border business makes it a logical currency to use for anyone undertaking international transactions. So this fact has advantages for the United States of America. American banks and firms enjoy the convenience value of being able to do business not only here, but internationally, using their own native currency. They don't have to go to financial markets to buy hedges to insure against untoward exchange rate movements, because both their payments for imported inputs and their revenues from exporting are all denominated in dollars. The federal government is able to borrow at a lower cost than would be the case otherwise, because there is this additional captive market for US Treasury bonds out there. There is an elastic demand for them from foreign central banks and governments that hold them as financial insurance, that hold them as foreign reserves. And because such a large share of foreign savings are in dollars, on deposit with the US banking system or pass through the US banking system, those facts can be weaponized. They can be used to our foreign policy advantage. And a prominent example of that would be in March of 2022, when Russia invaded Ukraine and the US, in cooperation with our foreign partners, imposed financial sanctions on Russia, which meant cut off their access to their bank deposits in the United States to their holdings of US Treasury bonds, which were on the books of the US Treasury, and prevent them from engaging in international transactions through the US banking system. So there are both, if you will, direct economic and financial advantages to the United States from the dominance of the dollar as the leading global currency, and geopolitical advantages accruing to the United States. So that fact is not exactly a happy situation from the point of view of our geopolitical rivals, and maybe from the point of view of some of our friends as well, who think that we have a exorbitant privilege that does not accrue to other countries as a result of the dollar's singular status, and that we have geopolitical leverage as well as a result of the dollar's global role. So John Connally, Richard Nixon's notoriously forceful, arrogant Treasury Secretary in 1971 was taken to task around these facts by foreign finance ministers. So the finance ministers of the 10 leading industrial countries, the Group of 10, were meeting in Paris in September of 1971, and the other 9 finance ministers were complaining about the behavior of the dollar and that the United States was using it to its advantage, and the US actually then wanted a lower, more competitive dollar to boost our exports, just like our current president would prefer a lower, more competitive dollar to boost our exports. And the Europeans and Japanese didn't want that, and Connally looked at them and he said, look, it's our currency, but it's your problem, which is also a book title that I suppose I could. That one actually has been taken, so I can't appropriate that one. So this is not an entirely happy situation for other countries. But despite the fact that it was unhappy fully half a century ago, the dollar remains dominant. And one reason for that is that in the interim, there was no serious alternative to the dollar as a currency with global reach. The difference now is that there could be alternatives to the dollar. So one alternative that people talk about is China's currency. China is a big economy. China engages in more foreign trade now than we do in the United States. So might there be migration over time by those engaged in international transactions away from the dollar and toward the Chinese renminbi? And another alternative people talk about are digital currencies or cryptocurrencies issued by central banks that were programmed so as to be interoperable with one another and could be used across borders as well. So I'll come back to both of those alternatives and explain their merits and limitations, if you will, a little bit more fully in a few minutes. Moreover, one can argue that reports of the dollar's demise, that there will be imminently rapid movement away from the dollar and toward one of these alternatives, those predictions may be exaggerated. In other words, the dollar's dominance survived the collapse of the Bretton Woods system, under which the dollar was pegged to gold for a quarter of a century after World War II. It survived the great inflation, the double-digit inflation of the 1970s. It survived the global financial crisis of 2008, 2009. It survived Donald Trump's first term in office, where many people worried at the time that US unilateralism would push other countries away from reliance on the dollar. None of those predictions came to fruition. So maybe worries that the dollar is now in 2025 poised to lose its international dominance could be similarly exaggerated. So what I do in the book, and what I will do for at least a few minutes now, is look to the history of international currencies, looks to previous monies, coins and currencies that have been widely used in cross-border payments, look at their rise and fall, and ask, what light does that history shed on the possible rise, on the past rise and possible future fall of the dollar as the dominant international currency. So when I began to think about this history, I saw I had to go way back in time. So this book project is really, for me, an exploration into archaeology. If you're going to go back and try to recreate the monetary and financial affairs of ancient Greece, 2+ millennia ago, you read what archaeologists write about. You know, they uncover coin hoards and pot shards and other evidence of monetary and financial activity. And you have to go back and read the literature in numismatics, the study of coins, which I'd never really done before. So that's kind of the fun part of writing a book. You are forced to read and hopefully learn new stuff that's a little bit outside of your comfort zone. So coinage was invented in the 6th century BC by the Lydians, tribe of people who lived in Anatolia, present-day Turkey, and they did business with the Greeks. So that's how coinage moved from Anatolia to Greece. And the little owls that Athens and its allies coined, I show you an example here, circulated throughout the Aegean and into the Middle East. The Roman coins of Julius Caesar and subsequent emperors, an example of which I show you here, circulated everywhere from Scotland in the northeast of Europe to India. Hoards have been found in both places and everywhere in between. When the Roman Empire split up into the Western Empire and Byzantium, headquartered in present-day Constantinople, you got the Byzantine solidists, which similarly circulated throughout Western Europe and into Asia. Starting in the 13th century of our modern era, the leading international currency was the Florentine florin, the currency of a relatively small city-state in northern Italy, one which did business all over Europe. Importantly, in this case, both commercial business, importing raw wool from England, exporting textiles all over the Mediterranean, but also did borrowing and lending in connection with that. Spanish pieces of 8, I show you here, 8 reals in a peso, if I recall my units correctly. So, you know, in the United States, if you've seen the musical Hamilton, you know that one of Alexander Hamilton's achievements was to create a mint in the US in 1792. That was not one of his more successful initiatives. There was a shortage of silver and gold in the US until gold was discovered in 1849 in a place about an hour and a half from where I live. So the mint couldn't coin gold and silver. It couldn't get its hands on gold and silver. This was legal tender. Spanish silver coin minted in Mexico and Peru, primarily, in the USA until 1857. So you could pay your taxes with this. And the reason these silver pieces were cut up into 8 sub-pieces is to create small change. The coins were too valuable to buy your Starbucks or 19th century equivalent, so they divided the 8 real coin into its 8. That's where the experience 8 bits, the phrase 8 bits comes from as well. The Dutch guilder was the leading international currency from the 17th, in the 17th and 18th centuries, and I show you here not the Dutch guilder, but the Bank of Amsterdam, the central bank equivalent of the Dutch Republic, because they created bank money, basically. Claims deposit accounts at the Bank of Amsterdam were used to settle cross-border business all over Europe and beyond. And then, of course, came the British pound sterling, which was the dominant international currency from the beginning of the 19th century well into the 20th, until it was finally overtaken by the US dollar. So if you look at this history, you see some regularities, some commonalities over time. These units, these coins and currencies became the dominant international currency for a combination of reasons. So ICS is my shorthand for international currency status. Has typically multiple foundations. It rests on the fact that the issuer has very extensive commercial and financial links with other countries, with the rest of the world. It does a lot of importing and exporting and borrowing and lending with other countries, making its currency a logical unit to use in those transactions. It's kind of the natural habitat for importers and exporters, lenders and borrowers of that country, and therefore for others, their counterparties in other countries doing business with them. International currency status benefits from, rests on the depth and liquidity of that country's financial markets. If it's easy to get in and out of the currency because the country has deep and liquid financial markets open to the rest of the world, that again lends itself to the popularity of that currency. And it's important also to have a central bank or equivalent to act as a lender and liquidity provider, guaranteeing the liquidity of the market in those assets, a reliable central bank to backstop the market. So that was the Bank of Amsterdam in the 18th century, the Bank of England in the 19th century, and the Federal Reserve after 1914. So there are these number one commercial, number two financial prerequisites for international currency status, but there are also political prerequisites, both domestic and international. So domestically, the currencies that are used globally tend to be those of states where there exists a separation of powers and rule of law, preventing opportunistic behavior by the issuers. So the king can't just change the rules of the game and appropriate and demonetize that currency, debase the currency, whatever. I see some people nodding their heads here. They know where I'm going. It will take me a few more minutes, however, to get there. Internationally, international currency status depends on the issuer's ability to forge and maintain strong geopolitical alliances, to which I will similarly return. Central banks, governments, and investors prefer to hold and use the currencies of their alliance partners for a good reason. Those alliance partners are viewed as reliable stewards of the currency, reliable places to hold your foreign deposits. Holding and using their currency is a show of good faith in your alliance partner. So maybe in the interest of time, I won't go into this in much detail, but you can see this in the each of the country cases that I referred to before. So go way back to the 3rd century BC, when the little owls of Athens began to circulate very widely. That was partly because Athens engaged in an extraordinarily large amount of foreign trade. Imports of grain into Athens in the 2nd century BC were larger on a per capita basis than imports into the Netherlands in the mid-17th century, when the Dutch guilder was the leading international currency. The issuing state has to have the administrative capacity to govern a large and powerful state and issue a currency to a regular, reliable standard to prevent counterfeiting, if you will. It has to maintain and protect the value of the currency, not debase it, not inflate that value away. In the case of Athens, the weight and silver content, that's what's meant by fineness, of the owls remained unchanged for several centuries. And it has to have political and military clout to defend its borders, encourage its allies to hold its currency. Athens was a powerful seafaring power that headed up an alliance of Greek states, the Delian League. Or you can look at Britain in the 19th century. Britain was, of course, the first industrial nation. It was the leading exporter of the 19th century. Its exports exceeded US exports right up until 1913. A quarter of the globe was painted red. That's the color they preferred when they drew a world map and said, these countries are our colonies or part of our Commonwealth and empire. Sterling was on the gold standard at an unchanged parity, at an unchanged value from 1717 until 1914, almost 2 full centuries. And being on the gold standard was kind of the good housekeeping seal of approval for having sound and stable finances. London was the leading financial center of the world. It had a liquid financial market, a liquid money market. Foreigners brought their money to deposit it in London and earn interest, and London turned around and lent the money to foreign governments, railways, mining companies around the world. And it had the first central bank that explicitly acknowledged that it had lender of last resort responsibilities. It was burned in 1825, not intervening to stabilize the money market in a financial crisis early enough. Ever after, it stood ready to intervene as needed and ensure the smooth operation of the London money market. A last point on this history would be that it suggests that international currencies do have something of an intrinsic life cycle. When your currency comes to be widely used internationally, the demand for that currency as reserves, for a means of payment, that demand tends to push up its value on the foreign exchange market, and that can create headwinds, difficulties for your exporters. The fact that the issuer has well-developed financial markets and foreigners are bringing their funds to your market to be deposited creates a temptation to move from, to use modern political language, from producing stuff to financial transactions, leads the country sometimes to specialize excessively in financial transactions at the expense of industrial and commercial activities. Economic and military reach can kind of shade into economic and military overreach, excessive military activities, foreign adventures that absorb resources better, devoted to more productive uses. And the end of the life cycle comes with erosion of the economy's economic and geopolitical preeminence, erosion of the currency's monetary and financial preeminence tends to follow. So the question is whether, each of the historical cases that I listed and a couple of them that I showed in the slides, Athens rose as an empire and military power and eventually fell to the Romans and others. Britannia first ruled the waves, and then after World War I, and especially after World War II, it no longer ruled the waves. And one can argue that its currency, in both cases, played a role in both the up and down phases of the cycle. That makes one wonder whether the dollar's international role, having played an important part in the emergence of the United States as the leading economy in the world, could also become a weakness now, both for the economy and for the dollar itself. So that brings me to the present. So I'm going to talk now about the present, and then I'll do what prudent economists never do and talk about the future a little bit as well. Let me start with the obvious alternatives. So I listed one of them, the Chinese renminbi, earlier. And I list another one here, namely the euro. So the euro area, the collection of, how many now, 20, roughly, countries, which all have given up their national currencies for a single European currency, the euro. The euro area is roughly as large as the United States, and it exports roughly to extra-European destinations, roughly as much as does the United States. The euro was created in part because of the unhappiness of European leaders with their dependence on the dollar, partly in order to create a rival to the dollar as a global currency. So it hasn't turned out that way. I show you here various measures constructed by the European Central Bank of the international role of the euro, measured in different ways. This is all a fairly complicated index, but it sums up how important is the euro in providing central bank reserves as a currency traded on foreign exchange markets, as a currency in which international bonds are denominated, et cetera. Add it all up, trace it over time. The euro has not been gaining market share relative to the dollar. Its importance, it accounts for about 20% of global foreign exchange reserves. The dollar accounts for 60%. And the euro's share has not risen over the quarter of a century now of the single currency's existence. For good reasons. There were doubts until European Central Bank President Mario Draghi made a famous speech in 2011 saying that he and the ECB would do whatever it takes to preserve the single currency, the euro. Right up until that point, people thought the euro might be reversible, might be temporary. So nobody was going to rely on it, invest in it to the same extent they invested in the dollar. There is no euro area treasury or fiscal policy like our treasury, which backstops the operation of our treasury bond market. Central banks in particular like to hold high quality, AAA, investment grade assets. And only 3 euro area governments have AAA ratings from the 3 major rating agencies. That's what I mean in this slide by a shortage of safe assets. And there is no European foreign policy, no European army to project political influence, or at least there has been none until now. What about the Chinese renminbi? After all, this is the currency of what's now the world's leading trading nation. Its currency is already being used to invoice and settle the majority of China's own imports and exports. It's widely held as foreign reserves by central banks around the world. So this pie chart on the right is my best effort to reconstruct who holds China's currency, the renminbi, as foreign reserves. About 80 central banks around the world publish that information with a lag of a year or 2. Russia published it up until it invaded Ukraine and the sanctions came about. So these are data for 2021 when Russia was still publishing. And the big blue slice of the pie is Russia. There are a lot of central banks that hold China's currency as reserves. But you can see that it's pretty heavily Russia because it feels its deposits in Shanghai are safe from sanctions. Its deposits elsewhere, not so much. The People's Bank of China provides renminbi to foreign central banks that need it. That's what I mean by renminbi swaps. It has designated one of its 4 big commercial banks as the go-to bank for doing payments in renminbi in each global financial center, including New York, including Toronto, et cetera. And it's developed interbank clearing and payment system. So we have the New York Clearing House, or CHIPS. They have the Cross-Border Interbank Payments System, CIPS, for where banks can go and make payments amongst themselves in China's currency. So they are building they're a big country. They're building all the same financial infrastructure that we have. Isn't the renminbi potentially a rival to a threat to the dollar? Well, not so much, because they are starting out so far behind the dollar and the United States. So we have been engaged in efforts to internationalize the dollar, to promote wider international use of our currency for more than a century. That was one of the Fed's priorities when, from the very point it was established in 1914. China has been engaged in the same process for no more than 15 years. So we have been building the relevant markets and institutions to support dollar dominance for very much longer. China's, the renminbi's share of international payments between banks is only 4% of the global total. Its share of involved in only 10% as many foreign exchange transactions as is the dollar. They have built their clearing platform for international banks to rival the New York Clearing House, but the New York Clearing House, CHIPS, clears 30 times by value per day the transactions that China's platform clears. And the Treasury bond market in the US is 5 times as large as all Chinese bond markets combined. So they are, field of dreams, right? They're building it in hope that they will come. But they are starting out so far behind that some years will have to pass before the renminbi can begin to rival the dollar, even given the way compound interest works. And that's what this slide basically says, that the renminbi is starting out far behind the dollar because we have been engaged in promoting international use of the greenback for so much longer. And because Chinese economic growth and export growth are now slowing down. 10 years ago, they were growing by 11 or 12% per year. Now they're growing by 4% a year. So, and courtesy of the one-child policy and all that, they're facing considerable demographic and other headwinds. And there's a last problem which will bring me to my remaining theme. I make this point whenever I go to China and I talk about this subject. So post-pandemic, I've been able to go, I went twice last year, and I talk about this subject and to my Chinese audience, and I say, every leading international and reserve currency in history has been the currency of a political democracy or republic. So I show you Florence, which was the Florentine Republic. I show you Venice. I could make the same point about the Roman Senate or about the Athenian Senate as well. The Dutch Republic, Britain had the Glorious Revolution, and then it had the global pound, or the United States of America. So I observed that an autocracy in which the president and the Politburo can arbitrarily change the rules of the game, its currency may not be attractive to international users who may be reluctant to park their foreign assets in Shanghai. So my Chinese audience is respectful. They listen carefully. They don't object, but they don't respond to the point either. What about digital currencies? Plain vanilla cryptos, the bitcoins of the world, are too volatile to provide reliable unit of account, means of payment, store of value services, the 3 things that are the key services provided by money. I would argue that stablecoins that are pegged 1-to-1 to the dollar or to another leading currency are either unstable or uneconomical. So if they're only partially backed by US Treasury bonds or some other safe and liquid asset, they're subject to bank run type problems. Confidence type problems. Tether ran into those a couple of years ago, and other stablecoins have as well. And if they're over-collateralized, they won't scale. If I have to give you more than $1 in order to get a dollar token provided by a stablecoin issuer, that's a bad bargain for me, unless I am engaged in tax evasion or money laundering or terrorist finance or some other illicit activity. Stablecoins are used, as you know. They have limited use by the aforementioned bad actors, but they're also used as on-ramps and off-ramps for buying other cryptocurrencies. They have limited use for remittances by people who are willing to take the risks, because transferring remittances by Western Union is expensive. But that's, those are our niche special cases. I would argue stable coins won't scale. What could conceivably scale would be a network of central bank digital currencies. So those come in two types. The central bank issues the equivalent of a token, which it drops into your cell phone app or cell phone wallet. Those tend to be used only for small retail transactions by travelers who want to buy a Starbucks in another country. That's not going to revolutionize the world economy, the global monetary and financial system. Wholesale CBDCs, on the other hand, where the central bank provides digital currency to commercial banks and other financial institutions that then use them to make large money transfers across borders, that could actually allow banks in other countries to avoid having to go through the US banking system and the dollar when they wanted to move money from South Korea to South Africa. Now if a South African firm imports semiconductors from South Korea, the South African firm has to first take rand, their own currency, buy US dollars, use the dollars to buy Korean won, and then it can pay the Korean exporter. A network of interoperable central bank digital currencies that could be traded directly for one another would avoid having to go through the dollar. And we actually have a use case of an example of how this would be organized. So this is a depiction of Project Enbridge from a year or so ago. This is a pilot project run by involving the People's Bank of China, the Hong Kong Monetary Authority, its central bank, the Central Bank of the United Arab Emirates, and the Thai central bank. Saudi Arabia is now the fifth participant, where they each have a central bank digital currency. They meet in the middle of a common platform where they do an exchange. One central bank digital currency is burned and the other one is coined. And they have actually done some actual transactions using this technology. They know how to program it, and it works. No obstacle to doing it, except for the political. The central banks and governments involved would have to agree on how to run this platform. Who would govern it? Who could use it? What the rules would be? How you establish those rules by consensus, majority voting, weighted voting, unweighted voting. I think we know how hard it has been to agree on the rules of the road, the governance of the World Trade Organization, for example. I would argue getting agreement on how to govern this thing would be even harder. So this is kind of a creature of the Chinese central bank, the PBOC. China and its friends might further develop and operate this kind of system, but that would not be a financial and payment system with global reach. Could Beijing and Washington, D.C. agree on how to run this new system and who would be allowed to play? That's harder to imagine. So governance problems are formidable here. So I'm going to go on. Am I able to go on for about 15 more minutes? Will that work? 10 would be better than 15. I thought you were going to say that. So my interim conclusion is the alternatives all have serious limitations. And the one thing that could dethrone the dollar from its global throne is policy mistakes in the United States itself. Fiscal problems that are allowed to get out of hand. So you know the story about exploding debt and deficits. This figure from the Congressional Budget Office is now out of date because today they released their new forecasts of deficits and the evolution of debt in the United States. But they still show it going up 2 decades from now to 156% of GDP, at which point interest payments will absorb 1/3 of all federal revenues. And it's not implausible, not impossible to imagine foreigners beginning to fear that the US will inflate away the value of that debt and that foreign holders of that debt will be the victims. And political polarization, we can talk about that in the Q&A if you want, makes it hard for the United States to get its arms around these debt and deficit problems. Financial problems could dethrone the dollar if there was another bout of financial instability, even worse than what happened when Silicon Valley Bank and Signature Bank and First Republic Bank failed in 2023. If deregulation of the banking and financial system, which is currently a thing, was allowed to go too far, that could undermine the confidence of foreign investors. If sanctions were resorted to too frequently and too indiscriminately, other countries imagining a scenario in which they too could conceivably become the target of US sanctions would have an incentive to move away from the dollar. So not much of that happened in 2022 because we cooperated with our foreign allies in imposing sanctions on Russia. So countries fearing that they might become targets couldn't buy pound sterling as protection because the Brits were on board with the sanctions. Will a future US administration cooperate with foreign partners when resorting to this mechanism? Compromising the independence of the Federal Reserve System would be the worst possible thing from the point of view of maintaining the confidence of foreign investors. So President Trump's acting Solicitor General issued a memorandum last month asserting that the president has power over a variety of independent agencies which are now required to pre-clear their policies with the executive branch. Would such a provision be applied to the Fed? We don't know, but were it applied to the Fed, I think we could predictably anticipate a negative reaction by foreign investors. Some of the chair of Mr. Trump's Council of Economic Advisors, Steve Moran, whose memorandum I show you here, has suggested taxing foreign purchases of US treasuries as a way of pushing the dollar down and rendering US exports more competitive. We can debate whether a weaker dollar would in fact stimulate US exports, but what I think is not debatable is that such a measure would strongly discourage international investors and others from holding and using dollars. Treasury Secretary Bessent has suggested that one way of dealing with the problem of heavy debt service payments on US government debt is by converting 5- and 10-year Treasury bonds into 100-year Treasury bonds and locking in an interest rate of, say, 2%, whether investors like it or not. I'm not making this stuff up. So that would not be confidence inspiring for foreign investors. And this is really my last point. Destroying US alliances could fatally undermine the geopolitical foundations of dollar dominance. So I have a paper in this journal from 2019, before any of this stuff started to happen, really, which looked at which currencies central banks held and as reserves and used prior to 1913, when there was the Triple Alliance and the Triple Entente, competing alliances in the period leading up to World War I. We looked at the episode in the 1960s when America's allies, the German and Japanese government, held and supported the dollar in the dollar's periods of weakness because they valued the U.S. nuclear shield and the fact that we had our troops stationed on their shores. So anything that might lead our former alliance partners to rethink their dependence on the United States for their own national security would not be a good thing from the point of view of the dollar's global role. How many of these things ultimately will come to pass, we don't know. But I think ultimately whether the dollar retains its international role is up to the United States to describe. And given that the dollar is the national currency of the United States, that's only right. So happy to take some questions and comments. Thank you.
That was less than 10 minutes. That was 6.
I tried to.
We have time for a few questions if anybody has some.
And we have a microphone as well.
This microphone, I think, is mostly for the video.
And you have a hand right by you there.
Thanks for the nice lecture. I want to point out one of your suggestion or your insight about the future cryptocurrencies because of the limitations. However, we know that U.S. is one of the largest holder of one of the largest major cryptocurrencies. Also, the government is trying to build a cryptocurrency kingdom, which is kind of a preemptive action, I believe, to hold on to the dominance in the digital currency too. Even so, without the strong hold to control the market, I believe based on your theory, still we can continue using, extending our currency, hold on to that. How do you think about the future of cryptocurrency?
So I will admit to some confusion about what the current U.S. government is trying to do in terms of building a crypto reserve and what the U.S. Senate Banking Committee has in mind by passing what it's called the Genius Bill, which is designed to encourage dollar-linked stablecoins. I think the crypto reserve is basically a non-starter from the point of view of the issues that I'm describing here, again, because plain vanilla cryptos are too volatile and too clunky to use, given current blockchain technology, to substitute for existing financial and payments channels. I think the more interesting alternative to ponder is whether these measures designed to promote dollar-linked stablecoins will cement the dollar's current dominant global role or not. And here I remain a skeptic for the reasons I described. The Senate Banking Committee bill envisaged fully collateralized or over-collateralized cryptos and stablecoins. And I do not see what advantage that has over the existing banking and financial system. So the current system for cross-border payments connects U.S. banks with foreign banks through this entity called SWIFT, the Society for Worldwide Interbank Telecommunications. SWIFT, based in Belgium. People complain about it because it's traditionally taken multiple days to move money between a bank in one country and a bank in another country. Now they do the majority of their bank clearing in 5 minutes. And they're going to do it even faster because they've been investing in all the same digital technologies that are being used in the crypto sphere. So I'm not convinced that stablecoins are going to be the wave of the future either. Not convinced they will transform the actually existing banking and financial system. But many people younger than me are convinced that this is coming. So wait and see.
See, currently the tariffs mostly are going to be a negotiation tool, hopefully so. If they come to become more semi-permanent or something, if they trigger a trade war kind of a situation, how does that affect the dominance of the dollar down the road?
So the question was about the impact of tariffs and trade wars on the global role of the dollar. So one of the points I made is that America's trade links with the rest of the world have always been an important foundation of the dollar's global use. So were the U.S., over time the U.S. share of global trade has been declining slowly and gradually. That's been not unhealthy for the United States or the world because it reflects faster growth in emerging markets. And there's a logic for why emerging markets should at least partially catch up with the United States. But skyscraper tariffs like we had in the 1930s, and these new tariffs look to be the highest we've had since the 1930s, with retaliation by other countries in a way that significantly reduced US trading links with the rest of the world, would undercut that important foundation of the global dollar. So a pithier way of my answering your question would have been to say 2 words: nothing good. Tariffs and trade wars would not be conducive to the maintenance of the dollar's global role. And we have one over here as well.
So one of the things I was curious about with your some of your graphs at the beginning, I was talking about the different currencies over time that have been dominant. How much time do we have, right? If it was just other things being neutral, right, equal. I was trying to avoid a Latin term. But considering what's happening right now, if we do put these tariffs hold, is 4 years enough to destroy our dominance as a currency, or would it still endure, considering the historical precedents that you talked about? I mean, do we have any way of knowing?
No, I don't think that this history allows us to make a forecast and put a date on that forecast both. So that's the first rule of forecasting, right? Either give them a date or give them a forecast, never give them both. It's tempting to channel the late, great MIT economist Rudi Dornbusch, who said, crises always take longer to develop than you thought they did, but then they unfold faster than you ever thought they could. I can't answer your question because I think damage is currently being done to US alliances and to the fundamental foundations of the global dollar. You have to tell me whether you think that damage can be undone by some future administration or not. You have to tell me whether the Europeans and the Canadians, how many miles from here? Not very many, will trust us again or not. And none of us know, so it's hard to make a definitive forecast, the kind of forecast that you're asking for.
Excellent. We'll have time for 2 more questions. What chance, if any, do you think of a second Great Recession hitting the United States within the next 5 years? I see it discussed more and more.
I'm not going to violate my first rule of forecasting, but I do. Like many people, I see a lot of evidence of declining consumer confidence at the moment. And consumption is 2/3 of the economy. I hear about a lot of firms that are delaying their investment plans. Investment is most of the other third of the economy because of policy uncertainty about where and in what to invest. So I think the odds of a recession are clearly going up. I give talks now and again to investment banks, and my fee is basically put me on your newsletter distribution list. So Goldman Sachs in the last week raised its forecast of the likelihood of a recession. I believe it was by the end of 2025 to 50%, way up from their earlier forecasts. So those are the folks in the business of answering your question. They do it for a living. I can't claim to do that. But that seems to be what the smart money out there is, the way they're betting. So they don't know either. 50-50 is kind of what you say when you don't know. But when you're worried about a bad outcome.
Hypothetically, someday, if US dollar is not the dominant currency, at that point in time, we still are servicing the debt. At 1/3 of our GDP goes towards servicing the debt. So would it not result in a serious contraction here at that point in time in the economy? Because we are not issuing any fresh bonds at that point in time because there are no takers, and we have to balance our budgets. How does it play out, if at all, if hypothetically someday dollar is not the dominant currency, euro or crypto or something else takes over?
So if the confidence of the international community in the stability and reliability of the dollar and of the country backing it were lost, the interest rates that the government would have to pay in order to induce investors to take that additional risk, that additional credit risk, would be higher. So there would be more debt out there. The interest rate that would have to be offered for the market to take it up would be higher, and debt service would be absorbing an ever larger share of the government's revenues. So how do these things, what are the options, what are the scenarios for what follows? One scenario is that the country gets its act together and figures out how to balance the budget. And there are good historical examples of countries that have just done that. So I mentioned Peter Henry, who gave this lecture a few years ago. He likes to point to his country of birth, Jamaica, as a country that had very much this problem, but got its political act together starting in 2014 and has, over the subsequent decade, reduced its debt to GDP ratio from 140% to 70%. So it can be done. I think it's easier to do in a small country where you can get the players around a table. Another way that you can deal with this problem is how Argentina has historically done it. You can just stop paying, which is not good for anyone. And you can lean on the central bank to inflate away the value, to inflate the denominator of the debt to GDP ratio in such a way that the legacy debt is no longer such of a problem. So all of those options are painful. Some of them are more constructive than others.
We thank you all for staying with us and hope you had a good time, and we look forward to seeing you next year, right, Mr. Chairman? Let's thank again Dr. Eichengreen for his wonderful lecture.
Thank you.
And have a good evening.